Ladies and gentlemen, welcome to BOQ's half-year financial results for 2017. My name is Tani Mangos and I'm the General Manager of Corporate Affairs and Investor Relations. Thank you for joining us today in the room, on the phones and via the webcast. For today's presentation, Managing Director and Chief Executive Officer John Sutton will provide an overview of the result. Chief Financial Officer Anthony Rose will then run through the numbers, and then John will return to discuss the priorities and the outlook for the full year. This will be followed by the opportunity for analysts and investors to ask questions. I'll now hand over to John. Thank you.
Well, thank you, Tani, and good morning, everyone. Before I begin, our thoughts are with fellow Queenslanders who have been affected by Cyclone Debbie. Our team nationally, and particularly in our home state of Queensland, is working to support our customers during this very difficult time. I'll now begin with an overview of our results. Our first half earnings declined on prior corresponding period. This was largely driven by revenue headwinds from a lower net interest margin during an intensely competitive market. Pleasingly, the outlook for the second half looks more favourable, with lending application volumes having picked up strongly in recent months across all channels. Margin headwinds are also abating. Our niche business segments continue to deliver. In the business bank, BOQ Specialists and BOQ Finance perform strongly. We've also seen good growth across our target niche commercial segments of retirement living, hospitality, franchising and agribusiness. Furthermore, we continue to make good progress with our mortgage channel diversification strategy. In particular, BOQ Specialist mortgages grew strongly, and we've achieved better than expected early take-up of the new Virgin Money home loan product. A key result of this result is the further improvement in our asset quality metrics, which reflects our dedicated approach to risk management. Additionally, the significant amount of work undertaken to advance our risk management capability provides a pathway to advance accreditation. Although there are pockets of weakness across the economy, we're not seeing any signs of deterioration in our loan portfolio. In a low revenue environment, we've remained focused on tightly managing our expenses. We are on track to deliver the 1% underlying expense growth target announced at our full year 2016 results. With a number of efficiency initiatives underway across the group, we're stepping up this focus and see further opportunities. Our capital and funding position remains strong on every measure. We are well placed for any regulatory changes and have the flexibility to capitalise on the positive structural changes that emerged during the half. I'll now run through the key elements of the result on slide 4. Cash earnings of $175 million was down 2% on the prior corresponding period, with a 2% decrease in headline expenses offset by a 4% decline in revenue. Cash earnings per share of 45.5 cents was down 5%. Return on equity decreased 70 basis points to 9.8%, which is a reflection of our elevated level of capital and the lower interest rate environment. The dividend has been maintained at 38 cents per share. Let's look at some of the drivers of the result on slide 5. In the first half, our loan book decreased to $168 million. Our disciplined approach to pricing and actions taken to remain within the APRA investor lending cap contributed to the contraction of the loan book. It was well reported how competition in the mortgage market was intense during this period. We prioritised margin and credit quality over growth in this half. We expect balance sheet growth to resume in the second half. The pipeline of mortgage applications in the past 6 weeks has increased substantially across all channels. Furthermore, we're not currently constrained by the APRA investor lending cap. Net interest margin reduced by 5 basis points over the half. This was largely driven by the highly competitive pricing environment for mortgages and the widening of term deposit funding costs. Anthony will address the details of the movement in his section. The net interest margin outlook for the second half is stronger. Term deposit spreads have improved in recent months. Front and back book pricing for mortgages is more favourable. Cost to income ratio was 47.4%, which was impacted by the decline in revenue during the half. Loan impairment expense has reduced 25% to $27 million in what remains a benign credit environment. This is a reflection of the improvement we've seen across the portfolio and our disciplined approach to risk management. Our niche strategy on slide 6 has continued to deliver positive results. BOQ Specialist remains an outstanding performer. In this half, 1,300 new clients were added, while the commercial and housing loan books grew 8% and 27% respectively on an annualised basis. In BOQ Finance, we've been focusing on using data analytics to better define segment profitability. Growth was achieved with an improved mix of higher margin business. The premium funding business acquired from Centrepoint Alliance during the half has been successfully integrated and rebranded under BOQ Finance. From day one, this acquisition has been earnings accretive. Our niche business banking segments have experienced annualised growth of 15% across our target sectors. We're adding further resources to build our capability in our niche sectors. We have also been successful in attracting new clients, and our business is more geographically diverse. The new Virgin Reward Me home loan product has gained traction with customers and mortgage brokers. Application volumes have been ahead of our expectations, with 2,677 brokers currently accredited. With $200 million in loan growth during the half, this book is weighted towards Sydney and Melbourne. The momentum in application volumes has continued in March, with the loan portfolio now over $250 million. The channel is attracting a younger, urban and more digital-savvy customer. Turning to asset quality on slide 7, we continue to see further improvement in our asset quality metrics. This is in part due to some of the benign economic conditions and our focus ensuring we have the settings to withstand the cycles. BOQ has maintained its process of validating 100% of all mortgages. We continue to run off lower quality business and replace it with much better quality business under our risk appetite. BOQ Specialist and Virgin Money are also providing further diversification to our portfolio. Competition in the mortgage market has moderated. The behaviour of our peers is more in line with the regulatory guidelines we implemented 6 months ago. Despite the pockets of stress in central Queensland and northern WA, our loan book is performing better than the market in these regions. We currently have only 2 impaired assets over $5 million. And now to expenses on slide 8. We are on track to deliver on guidance we provided at our full year 2016 results for 1% underlying expense growth in FY17. Headline expenses were down 2% on the prior corresponding period and only up 1% on an underlying basis. This was achieved despite absorbing a $6 million increase in amortisation expense and a $4 million increase in expenses related to the Virgin Money rollout. Excluding these items, expenses were down $8 million or 3% on the prior corresponding period. The $15 million investment we announced in February last year to refine our operating model delivered the cost savings within the targeted 12-month payback period. We see further cost reduction opportunities throughout the business, which Anthony will elaborate on further. Turning to the balance sheet on slide 9, BOQ remains very well capitalised on all measures. Our CET1 ratio strengthened by a further 29 basis points to 9.29%. When combined with our peer-leading ratings capital position and higher mortgage risk weight ratings requirements, we are well positioned for any upcoming regulatory changes. With our level of capital and healthy deposit-to-loan ratio of 71%, we have the capacity to fund asset growth in the second half without putting stress on our margins. Let's look at the progress we've made against our strategic priorities on slide 10. We have successfully launched the Virgin Money Reward Me home loan and significantly increased the number of brokers accredited to distribute this product. We've continued to optimise the branch network with more than 60% of owner-managers transitioned to the new franchise agreement. We've made good progress in utilising data analytics to optimise deposit pricing and investing in higher margin segments. We've delivered efficiency program savings targets and continue to identify further opportunities. Finally, conduct and culture remains a focus across the industry as a whole. At BOQ, we are continuing to roll out our ethics training to our employees. I'll now hand over to Anthony to run through the numbers in more detail.
Thanks, John. I'll start with an overview of the P&L and then go into detail on each of the line items and drivers relevant to each. The bottom line result has been driven by a lower revenue outcome during the period. Net interest income was down 3% on the prior corresponding period, with the loan book contracting 1% and margin compression of 5 basis points in the half. Non-interest income was down 6%, which meant total income was down 4% on the first half of 2016. Operating expenses were well managed, down 2% on the prior corresponding period, and credit quality performance was very good, with a 25% reduction in loan impairment expense. EPS contracted 5% as a result of the reduced earnings and shares issued under the dividend reinvestment plan. Return on average tangible equity was down to 13%, about half of which was as a result of reduced earnings and the other half a function of dilution from higher capital levels. So in summary, the expense management and asset quality metrics are pleasing, and we do expect better revenue momentum in the second half of the year, which I'll discuss in a little detail later. Turning to the loan portfolio, at an aggregate level, we did see a contraction in the half, primarily due to the housing loan book. In this half, we prioritised margin and credit quality. This has been an intensely competitive period, not just in lending, but also in retail deposits. I'll expand on this as we go through the presentation. As you can see from the chart on the bottom left, Queensland concentration has reduced down to 47% of the total lending portfolio. Focusing on the housing book, and I'm now referring to slide 14. BOQ Specialist has continued to generate good mortgage growth, and we have seen a stronger contribution from Virgin Money mortgages since the offering was launched in May of last year. BOQ Specialist delivered growth of around $400 million, while Virgin contributed $200 million. Both of these channels have helped diversify the housing portfolio and a higher proportion of business coming from New South Wales and Victoria. The branch network has continued to see net runoff, with settlement volumes not at a level sufficient to offset the natural amortisation occurring in that book. We saw only $50 million of growth from the broker channel during the half, compared with an average of around $500 million from this channel in the prior half-year periods. This was the biggest driver of the portfolio contraction during the half. The drop-off in settlement volumes from broker channel is clearly evident in the chart on the top right-hand side of the slide. We spoke at our full-year results last year about the steps that we had to take to manage under the regulator's 10% cap on investment lending growth. This did create issues for us in the broker market, and our return to growth has taken longer than we would have liked for a number of reasons. Firstly, there has been a lot of regulatory focus on serviceability calculations and ensuring living expenses are appropriately considered as part of any lending application. We have been very diligent in this space, taking a prudent approach to these assessments and ensuring we are meeting the regulator's expectations. It's fair to say there have been some different policies in use across the industry and variability by borrower type, geography, income levels, etc. In many cases, we've found that we were willing to lend a lower maximum amount than our peers, particularly in Sydney and Melbourne markets, where the strongest growth has been. As a result, we found ourselves off the consideration set for many brokers. Secondly, our application processing for broker-generated loans has been more onerous for a couple of reasons. We still complete validation of 100% of loan applications. This is a time-consuming process. It involves reviewing the customer's application and ensuring that income and expenses declared and used in the assessment can be verified from supporting documentation and is consistent with activity on applicants' bank statements. We've also still been in the process of rolling out the second phase of our retail lending origination system, with the second drop of code for this system landing in December. This will enable up to 70% of applications to be processed through the new system over time. We're still working to improve other elements of the end-to-end lending process to ensure we become easier to deal with for brokers, branches and customers alike. By the end of this calendar year, we should be in a much stronger position in this regard. Lastly, we have made a conscious decision not to move our pricing point to the sharper end of the market. Given the pressure we'd seen on the funding side of the book, we were not willing to pull the price lever to generate growth. We believe this was the right approach. We've seen much more promising application levels in the past 6 weeks. Application levels have been running over 30% higher in the last 6 weeks than the average for the first 4 months of the year. The increase in applications appears to be partially driven by credit and serviceability standards of our peers, being brought more into line with where we have been operating for some time. This more level playing field improves our ability to lift new business volumes and gives us confidence of returning to a reasonable level of mortgage growth in the second half. Moving to the commercial book on slide 15. BOQ Specialist and BOQ Finance have contributed solid growth relative to the markets that they operate in. BOQ Specialist grew by 8% annualised over the half, and we would expect it to grow faster in the second half, consistent with its historical seasonality. BOQ Finance has improved its business mix with 11% annualised growth in the higher margin structured product offerings. The traditional broker-originated equipment finance portfolio declined, which is a more competitive and lower return segment for us. We completed the acquisition of the Centrepoint Alliance Insurance Premium Funding business during the half, which has added around $120 million in loan balances. This business complements BOQ Finance's existing product offering and is a natural extension of our niche segment strategy. The BOQ commercial book has contracted slightly over the half. We continue to see a reasonable pipeline of opportunities that meet our risk versus return hurdles. As we've said previously, we don't expect growth in this portfolio to be linear. In the half, we did see a small number of large customer paydowns driven by some large asset sales that impacted momentum. Thank you, John. As John has already mentioned, we've continued to make good progress in our niche target segments, with strong growth being delivered in these sectors. Once again, you can see the improvement in diversification here, with the Queensland concentration down to 39% in the commercial book. Turning to funding on slide 16, and we've taken the opportunity to improve the mix of the book given the lower asset growth that we've seen during the half. As many of you would be aware, we have had the highest dependency on term deposits compared to our peers. When I go through the margin walk shortly, you will see the impact that this has had on net interest margin over the half. We also historically have had the highest pricing premium over our peers on term deposits. We see this as a clear opportunity for us to improve, and we have been very focused on building capability over the last 6 months that will support our ability to narrow the gap over time. We do see opportunities from utilising data analytics to continue our to optimise our term deposit pricing and reduce our reliance on higher cost segments of this market. We've had some success in achieving this through this half, but recognise there is still much more for us to do in this space. We've continued to see strong growth in mortgage offset accounts. Although this is an expensive form of funding, it does signal an improvement in gaining main financial institution customers. And very importantly, with the lower asset growth this half, our deposit to lending ratio has increased from 68% to 71% and is now comfortably above our 65% to 70% target range. This gives us operating leverage to grow the balance sheet without placing undue stress on net interest margin, now that conditions have become more favourable competitively for us to grow. Looking now at net interest margin, and on slide 17, we've tried to provide some insight into some of the external factors that significantly impact this metric. The 2 charts at the top are an update to the charts we provided last half, which demonstrate the reduced return that is being achieved on our capital and low-cost deposits. These balances have historically been reinvested at the prevailing 5-year rate as part of a replicating portfolio that sees 1/60th of the portfolio roll off and reinvested each month. The declining 5-year rate meant a gradual decline in returns on this portfolio. Given the shifting outlook for rates, we've recently moved to a 3-year investment horizon for this portfolio in order to capture the benefits of a rising rate environment sooner. I'll provide more detail on what this means for our margin on the next slide. The bottom two charts demonstrate the significant increase in the cost of term deposits over the last two halves. As you can see from these charts, term deposit spreads peaked in late last year, but have been improving since that time. Given the profile of this chart and the lag effect on the portfolio, we have seen the impact wash through margin in this half. The improvement in the profile since late last year, however, means we expect this to unwind in the second half if current new business spreads prevail. Getting into the specifics around our margin outcome for the half, and I'm now on slide 18. Starting with the asset side of the balance sheet, and there was a net 2 basis point benefit from in the half from asset pricing and mix. We felt the usual headwind from the front to back book pricing dynamic that continues to prevail across the industry, with an impact of 4 basis points over the half. This was more than offset, however, by a 6 basis point benefit from repricing that occurred through the course of 2016 and early 2017. The total benefit of that repricing was actually more like 8 basis points, but the prior half had the benefit of some repricing timing differences that were not present in this half. On the liability side, I've talked about the spikes in TD spreads that occurred in May and August last year, which significantly increased the portfolio spread for our TD book. This impact was in the order of 13 basis points from the second half of 2016 to the first half of 2017. Given the high proportion of our funding from term deposits, this has resulted in 3 basis points of NIM compression during the half. The other element I covered on the previous slide was the return on our replicating portfolio, or the investment of our capital and low-cost deposits. Due to the drop in returns experienced on this portfolio, we saw a 3 basis point impact on the net interest margin. Given the changes we have made to reduce the investment time horizon of this portfolio to 3 years, the returns on this portfolio are expected to have a further 2 basis point impact of a negative impact to margin in the second half. However, there is not expected to be any impact on margin from the returns on this portfolio in 2018. That is, if you assume that interest rates track the profile implied by the current yield curve. The last bucket we have on the chart is 1 basis point, which is attributable to the higher level of liquid assets we were carrying during the period. This is really just a denominator effect in the margin calculation. We tend to carry more conservative liquidity over the holiday period and have pre-funded some larger wholesale debt maturities during the period. We would expect this to unwind as our liquidity levels normalise. Thinking about the outlook, the one constant at the moment is the front to back book pricing dynamic, which is currently driving 3 to 4 basis points of NIM degradation each half. We expect this dynamic to continue. However, recent industry pricing changes do point to a potential for the gap to narrow. Whether that can be sustained for any length of time is the open question. The repricing that has been implemented to date is expected to provide a further benefit in the second half of approximately 4 basis points. We also expect a benefit of around 1 basis point from the cash flow finance business acquired during the half, which is mix related. You'll note we haven't seen any impact from hedging costs this half, given the stabilisation of the cash to bill spread. That leaves the funding cost and mix bucket. The chart on the previous slide provided an indicative forward profile for our TD book should new business spreads for us stabilise at 60 basis points. As you could see on the chart, this outcome would drive a 14 basis point reduction in our term deposit portfolio spread from the first half to the second half of 2017. This would effectively reverse the experience we encountered in the first half. Some recent pricing changes in savings accounts rates will also provide an additional basis point of margin improvement. We also expect about a basis point of benefit in wholesale funding costs if current conditions are maintained. The net result of this is that we believe the impact experienced in the net interest margin in the first half will reverse in the second half. We expect margin to return back to the level we achieved in the second half of 2016, which was 1.90%. As always, things can change quickly. We remain focused on managing margin on both sides of the balance sheet. Turning now to non-interest income on slide 19. We've said in prior periods that this is a challenging line for us and we need to pedal hard to try and keep it flat. That has been particularly difficult this half. Banking fees in general continue to reduce as customer preferences necessitate a shift to lower or no fee products. After several periods of above expectation trading profits, the trading result was lower by $5 million on the prior half. There was also a reduction in banking income of $3 million related to changes in an outsourced portion of the bank's ATM fleet, where a commensurate reduction in expenses was recognised. The St Andrews insurance income was flat on the prior half, with the impact of changing business mix to wholesale lines and a decreasing proportion of single premium business. This has seen earnings declining in recent periods, with the trend now flattening out. The insurance market is undergoing significant industry change, and heightened regulatory requirements create uncertainty to the outlook. We continue to target a flat profile in this line item for the second half, with work to do to achieve that, and with very few levers available to drive non-interest income growth at this point in time. Looking at expenses on slide 20, we've delivered a good result which is in line with the guidance provided last year. The increase in amortisation and increased impact from the Virgin Money rollout have been absorbed as we said they would. We've been successful in delivering the run rate required to deliver on a 12-month payback of the $15 million we invested last year. In fact, with the initiatives we now have underway, we expect to deliver well in excess of the $15 million in savings we were originally targeting, although much of this will be reinvested in the business, including through additional efficiency initiatives that give us confidence of continuing to improve our operating efficiency over time. We remain comfortably on track to achieve the $510 million operating expense target for the full year, with the premium funding business acquired in January expected to add around $4 million to the previous guidance. Moving to asset quality, and we've seen further improvement across most metrics in this half. Loan impairment expenses has reduced to 13 basis points on the overall portfolio. Reduction in impairment expense was evident in the commercial and BOQ finance portfolios. There was a $3 million increase in the impairment charge in the retail portfolio compared to the prior half. We've seen some higher loss given default rates in the areas that I'd categorise as being in the tail risk category. These are related to the regions in central Queensland and northern WA, where corrections in property prices have been the most severe across the country. We are talking small numbers, and we are very comfortable with our relative positioning in these locations. Impaired assets have reduced by another 9% on where we ended FY16, whilst recognition of new impaired assets was down nearly 30% on the prior half. We have only 2 impaired assets greater than $5 million, with no new impaired assets recognised above $5 million identified in the past 2 halves. The arrears charts on slide 22 also provide a picture of good portfolio health, with the normal seasonal uptick still well below the level levels seen this time last year in the commercial and BOQ finance books. The housing portfolio has been fairly flat, with no issues emerging in this portfolio that keep us awake at night. Pleasingly, we've seen very little seasonal arrears in the portfolios that we would normally expect to see at this time of year. Given our history, 90-day mortgage arrears in the low 40s is a very pleasing result and compares favourably across the sector. Moving to capital on slide 23, and as John has mentioned, we remain well capitalised on any measure. S&P's risk-adjusted capital measure is becoming an increasingly relevant metric given S&P's negative outlook for the sector and the impact of the relevant capital band in determining their rating outcomes. At over 13%, BOQ sits in the strong capital ratio category, while the major banks sit in the adequate category with RAC ratios below 10%. Regardless of the outcome of the Basel Committee's deliberations and APRA's interpretation of unquestionably strong, we remain confident that BOQ is extremely well placed to adapt to any new requirements. While the benefits and ultimate pathway to achieving advanced accreditation remain unclear, we've continued to make good progress towards being a better run bank. We remain committed to improving our risk management capability and stand ready to make a decision on whether or not to accelerate any investment toward advanced accreditation when and if the potential benefits from doing so become clear. With that, I'll hand back to John to wrap up.
Well, thanks, Anthony. I'll start by looking at the external environment before moving to the outlook for the rest of the year. The industry is facing increased scrutiny from community, politicians and regulators. People expect more from their banks, particularly in terms of trust. At BOQ, we've been proactive with the establishment of an ethics committee in 2015, the rollout of ethics training to our staff. We're also leading the charge in our support of the banking and finance oath. I'm proud to report that BOQ has the largest percentage of signatories to the oath of any bank. Conduct reform across the industry is vital. The ABA's six-point plan sets out a series of actions to be taken by the sector to making banking easier and more transparent for customers. As part of this, we've recently appointed a customer advocate. The industry as a whole is making tangible improvements across a number of areas. BOQ continues to progress on each of the six-point plan initiatives and is on track to deliver these by the required dates. We also welcome and support the ABA's response on Tuesday to the Code of Banking Practice. It'll take time for the industry to rebuild trust. Even though BOQ is in a strong position, there is always more to do. Looking at the economy more broadly, New South Wales and Victoria continue to be the strongest state economies. There have been signs of improvement in the WA economy, supported by stronger commodity prices. Queensland is performing a little better than WA, reflecting the more diversified nature of the economy. Tourism, agriculture and education has been positive for Queensland, as has rising exports. Economic conditions remain mixed between Queensland regions. The unemployment rate in the southeast remains well below the state average. While conditions remain tough in central Queensland, there are signs this might be drawing to an end. Turning now to our priorities on slide 27. We continue to strive towards our vision of becoming Australia's most loved bank. Our focus on niche segments that value a more intimate customer relationship remains unchanged. In the second half, we'll continue to expand the distribution reach of Virgin's Money Reward Me home loan. We'll see a lot of growth potential for this business with sustained credit card balance growth of over 15% for the past 3 years, demonstrating the power of the brand. We'll continue to find smarter ways to attract and retain deposits, not just by offering the highest price in the market, but by using more sophisticated data analytics. We'll drive additional benefits from a number of efficiency initiatives underway across the group to ensure we're always finding better ways to do things. Our diversity and ethics program will continue to be rolled out. We remain focused on setting a high standard in the quality of our people and how they conduct themselves. In summary, we've delivered a credible result in difficult revenue environment. We expect revenue growth to resume in the second half with an improved outlook for net interest margin. We've seen a 30% improvement in mortgage application volumes in recent weeks, which will lead to a return to growth in the second half. By the end of the calendar year, both BOQ and Virgin will be launching new and improved customer-facing websites. These websites are not only designed to enhance the customer experience, but will provide opportunities to grow and improve customer uptake of products and services. Our strong capital and funding position means we have the capacity and flexibility to capitalise on the positive structural changes which appear to be turning in our favour. Our Common Equity Tier 1 ratio of 9.29% compares very favourable with peers, particularly when adjusting for our higher mortgage risk weightings. We have strong relationships with the regulators and will continue to maintain our risk and pricing discipline. Efficiency remains a key focus. We are committed to delivering on the 1% underlying expense target. We've embarked on a transformation program to find further productivity efficiencies across the organisation. Even though it's been a tough environment, we're at a turning point. Our increased mortgage momentum, outlook for revenue growth and capital optionality all provide a strong framework to deliver on our full year targets. Thank you for your time, and we'll move to Q&A. Thank you, Tani.
Thanks, John. We'll be taking questions from analysts and investors only. For those in the room, can you just please wait for a microphone and state your name and organisation you represent? Let's begin with the room first. To my left, Jonathan.
John Mott from UBS. I've got a question. It's actually from the result, so the bigger result, page 15. There's a table at the bottom of there that you can see which breaks down the movement in the lending book for the mortgages across BOQ, the Virgin Money and BOQ Specialist. And you can actually see that the BOQ brand has run off at an accelerating rate. And if you go through why that probably is, if you go back to 2012, there were 200 owner-managed branches and you're now down to 115. And as you close branches, it's kind of like a store rollout working in reverse, where you close it and then the book will amortise, and after a few years the amortisation accelerates and customers start refinancing away. So as this continues and the branch network shrinks, wouldn't you expect this runoff of your back book to, if nothing else, accelerate? And so while you're getting a pickup on your front book, which we can all see coming through now, won't that be offset by an increasing runoff of the back book, leaving it pretty hard to grow the book going forward in future years?
Well, it's always good to have you to ask the first question, John. So, thank you for that lengthy question as well. Really pleasing to say, look, we're looking at our application volumes every day, and our owner-manager network is at about 113% of its target over the last few weeks. And Matt, our head of retail, has just been around the country, and the optimism amongst our network is at the highest it's been for a considerable period of time. I've spoken a lot about channel diversification over the last few halves and results presentations. We need to make sure that our branch network is optimised. We need to make sure that we're in all the mortgage channels that customers choose to deal with. And significantly, the broker channel has been increasing significance. And with both Virgin, BOQ Specialist, and I am confident that our owner-manager network will get back to growth, that we will see an uptick in our mortgage growth. What's really important is for us to be open with customers how they want to deal with us. And that's a combination of the brands that we talked about. Our owner-manager network is increasingly important. We had a reduction of branches in this last half, but a lot of those branches were actually some of the owner-managers actually retired, but other owner-managers bought those branches. And where we've seen those owner-managers take on those additional branches, they've actually done very, very well. So, we're comfortable with where we're at with that at the moment.
Question just here to the right. Thank you.
It's Andrew Triggs from Deutsche Bank. A couple of questions, please. Firstly, on the it was a strong cost performance in the half, but maintained the 1% underlying cost growth guidance for the full year. Just that I think on my numbers assumes about a 3% step up in costs in second half. Is that a seasonality issue around the timing of wage increases, or is that amortisation expense coming through? Second question, just on the change in funding mix during the period, we saw a sizable reduction in the reliance on wholesale deposits and a step up in retail deposits. Do you think that mix is now improved? I note that 107% NSFR level seems about where the peers sit now. So is that any more work to do there, please?
I'll let Anthony talk about the cost piece, but what I will say, just at a general level for those things, on costs, we remain really, really focused in what I describe as taking bad cost out of the organisation. There is still plenty of space for us to look at optimising what we do across our cost base over the time. And I'll have more to say about that at the next set of results. What we have done successfully is absorb the amortisation costs absorbed the rollout of Virgin, which is proving to be a great product for the market and really proves the power of that brand up. So, we will remain really focused on costs. In terms of the deposit mix, we saw a significant cost to us with the term deposit pricing that we saw as all banks ran up to get to their NSFR. We've seen that moderate, but what's more important is that we've actually been using a lot of data analytics to actually manage that term deposit pricing mix. We've done a lot of that around our what I would call our Treasury retail deposits, and we'll be rolling that out to our owner managers. So again, we've got a nice tailwind coming through on that at the moment as the industry reprices TDs, but we're also looking to do better than just that tailwind.
I might just add, just to make give a little bit more clarity on the cost guidance. We gave very clear guidance for the full year around the 510, and we're saying that we are comfortably on track to deliver that outcome. We obviously calling out separately the additional $4 million from the acquisition of the insurance premium funding business. When we say we're on track, yes, there'll be a little bit of an uptick in amortisation. The salary increases would have been in this half as well, so there's nothing in that to call out. But it will obviously be working hard to try and achieve better than that profile, albeit we're not in a position to make that a definitive point at the moment. So, but you can see by the numbers in the first half, we're pretty comfortably on track for that profile. So, potentially a little bit of upside from that if we can achieve our targets. On the net stable funding ratio, I think it clearly comes out in what's happened in the term deposit space that we saw some very aggressive activity, which was very clear, I think, in the chart that we provided, which coincided almost like a perfect storm with what regulatory changes were sitting across the top of it. We are at 107% of NSFR. We believe that that's an adequate level to commence the compliance with the new framework on 1 January 2018. There's probably a progressive uplift in that over time. Call it to the 110 area, but there's a 3-year implementation time frame for that, and we don't see anything significant that, as far as stress is concerned, for the industry to orderly transition to that profile.
I think we've got one question behind Andrew.
Victor Gelman from Macquarie Bank. I was just hoping to follow up on John's earlier question around volumes, because one of the I guess disappointments or challenges in this result was around margins and volumes. I think Anthony provided some good colour around margin piece, but I think it'd be quite useful for us to get a little bit more insight in terms of where the volumes are being driven by. And I appreciate your comments around seeing better flow. We'd be really interested to hear about. We know that you've got a new product out there that is actually very competitive now in terms of pricing. To what extent that's one of the drivers of better flows. Also, some insight in terms of the outflows from a less competitive SVR product that potentially is driving some of those challenges around volume growth would be really useful.
Let's just expand a bit on that, because there's quite a bit in John's question and quite a bit in your question. So let's just start with underwriting. The regulator has been very prescriptive about their underwriting standards for mortgages. Both regulators have, and particularly around responsible lending. So we've always validated 100% of the mortgages that come through. We've always asked for detailed income and expense assessment, and there's been pages and pages written recently about HEM. And what we did see over the last 6 months was super competition. So a number of the majors scooped up an enormous amount of mortgages in a very short period of time at very competitive pricing. So we made a decision not to match that price. So that's part of that's part of the flow that we didn't see. The second part that is really important, which we are now seeing the market come back to us, is around the underwriting standards. Now, there's any number of articles been written in the last 3 weeks about banks that have been sending out to brokers detailed income and expense assessment questionnaires to validate income. What we found, particularly in the Sydney and Melbourne market, when we were on the consideration set, that we could not match the maximum loans that were being offered. So, for example, family, husband and wife, both working, we might offer, say, $900,000 as a loan, whereas competitors were offering 1.2. So we saw that as well. In terms of what we've seen over the last 6 weeks, I just want to be really clear on this. Our increase in mortgages, the 30% uptake in application volume, is not because of investor flow at the moment. We're seeing a good range of owner-occupier and investor across the various brands. And we've seen our owner-manager network also pick up in terms of their flow. So, sure, we would have liked more growth in the last 6 months, there's no doubt about that. But what price do you want it at? And what we have seen over the last 6 weeks is front to back book margins narrow. You have seen a lot of banks change the competitive position around LVRs. You've also seen a significant movement, probably more towards where those regulatory practice guidelines have been around income assessment and expense assessment. Our Virgin Money product, it is not the cheapest in the market. It does have some bells and whistles, particularly around the frequent flyer points. It is priced at different price points for different LVRs. BOQ Specialist continues to grow its mortgage book at 27%, and we have, we're at 250 million now for Virgin on the sheet already. So that's 50 in the last month, and those applications are increasing. The next cab off the rank for Virgin will be a deposit product. So in the last 6 weeks, I am confident that we are getting back to growth in our mortgage market, and it is coming across all the channels. Interestingly enough, just the last few days, when you look at where some of the flows are, we are starting to see an uptick in the investor flows. We are well and truly below our 10% cap. But again, we're going to watch closely at where those flows are and manage that very closely.
I might just add to that we're all aware that the investor space has been rapidly growing across the sector. There is an appendix to the presentation on page 31 where we set out our portfolio metrics. Our investor flow, our owner-occupier flows were 70% of our volume through this half in settlements, and obviously our portfolio is much higher weighted to investor than that level of flows. What we have seen over the last 6 weeks is a lift in investor back to a natural portfolio position, but it does demonstrate that we haven't been in a part of the market that has obviously been the highest growth element through this period as well.
Sorry, just to be clear, that we're getting the message right, it sounds like you're saying that predominantly the issues are around flow rather than back book amortizing.
Yeah, all back books have the natural element of amortizing. And in fact, our back book is probably doing a little better than what we thought on what the natural amortization would be. We do a lot of work around retention as well, and we've had some success around retention. But a couple of halves ago, I talked about the velocity of mortgages and how quickly and dynamically that flow is moving across the industry. And the influence of brokers is quite large, and the influence of brokers in terms of customers wanting to deal with brokers. We don't have a problem dealing with brokers. We think it's a great part of the industry. But again, brokers are influencing heavily what customers are doing. Customers are very savvy as well. They sit and watch their morning breakfast television, and if someone's saying your mortgage doesn't start with a 4, that they need to change. So we are seeing that velocity across the industry. But in the last month, there has been a significant change in the industry, particularly with what we're seeing with flows and how banks are pricing, and also the bifurcation of pricing for risk across the mortgage market. They are significant changes.
Question.
Which we think provides us with a lot of opportunity as well.
Okay, thanks.
Hi, it's Brendan Sprouse from Citi. Just a question on your capital position. You described it today as very strong, but I did notice that you've retained 30 basis points this period, but you've decided to keep the dividend flat, and you've also maintained the discount DRP, which obviously has diluted EPS a little bit relative to cash earnings. Just some insight into why you took those decisions.
At a high level on the capital front, and Anthony will take you through the dividend and the discount. There is a lot of uncertainty still around the capital position and what's going to happen with Basel IV. And I know a lot of you analysts write a lot about this, and it's still very uncertain. You've got the Europeans on one side wanting something, you've got the Americans on the other side of wanting something, and then you throw in our own regulator, APRA, who's opining on unquestionably strong, and there were some notes out yesterday that said over the next couple of months that will become much more clearer. So we're probably a bit conservative on where our capital stands at the moment, but we do believe that once there is greater clarity over what the regulatory environment will be, that we'll be in a position to either optimise capital. We've got a great balance sheet at the moment that will allow us to grow. So we're probably running a tad rich, but it's the right time to be doing that, as there is a high degree of uncertainty over what the capital outlook will be, and more importantly, it helps us with our growth in the second half and future periods.
And just adding to that, nobody knows the answer to that question. So whilst I think our view would be on a central estimate basis, we're probably adequately covered and comfortably covered for where the new standardised framework may land in APRA's unquestionably strong position, but there is always the risk that they could set the hurdle for the industry sufficiently high that we require more. So I think the answer is, to your question, Brendan, that we've kept the settings consistent. We've delivered a dividend which is consistent with our guidance around starting to track our earnings per share growth, and albeit there's some degrading of EPS in this half, but I think the message we've provided for the outlook in the second half is consistent with the profile. But once, and we were hoping we would be further advanced given Basel's meeting, which was kicked down the road, with some greater clarity. It still does appear that within the next 3 to 6 months we'll have some sufficient guidance as to where the industry's headed and where APRA wants to move in particular around unquestionably strong. Post that, and when we understand what the landscape looks like, we clearly need to go through an exercise of understanding how to best optimise our capital position relative to that framework. As we've said in the past, we don't want to run a lazy balance sheet. Our preference would be to optimise our position, balancing our expectation for medium-term growth aspirations. So we'll obviously have to look at that in the context of when that becomes clear.
Brendan, I think Ed behind you would like to ask a question.
Thank you. It's Ed Henning here from CLSA. Just a couple of questions from me. During the period you closed 14 branches, is there any more headwinds going from there? You've converted 60% of the owner-managed branches and you've got 40% to go. Is there any headwinds there? Also, just a clarity just on the margin. At the moment, you guys seem to be heavily discounting your front book, both on owner-occupied and investors, one of the sharpest rates out there. Is this factored into your NIM guidance?
Just on the pricing, it is not the cheapest pricing in the market. We review the pricing almost on a daily basis, weekly basis, given what some of the competitive tensions are. And I draw you back to Virgin. We do differentially price on that for LVRs and for investor and other pieces. On the balanced scorecard, really happy with the progress we've made. That the balanced scorecard has significantly changed the performance of the owner managers. You go back 5 or 6 years ago, it was very unsophisticated. It was pretty much like a simple broker type arrangement with an upfront and a trail. And the balanced scorecard now rewards our owner managers for looking after both sides of the balance sheet, for also looking after the customers that they care for. Also has significant weightings around behaviour and ethics. We will continue to roll that out. So as a new owner manager comes up for a renewal and agreement, they're signing up. And the examples that we've had, some of our best owner managers have significantly increased their earnings through concentrating on the balanced scorecard. It's helped us with deposit gathering. It's helped us with opening up current accounts. It's helped us in making sure that we look for the cross sales across our business. And even in Hugh Lander's BOQ Finance business, we've had some outstanding results with our owner managers on that. So we'll continue to push on that, and I think I've given a fair commentary on the around the branches. BAQ a few years ago, we had over, what was it, Matt, 280 branches on any size of, if you looked at footings, that was an enormous branch network, and no broker. So again, what we have done over the last few years is diversify our channel optimisation. Sure, we could have had better growth the last half, but we've got Virgin coming online, BAQ Specialists doing well, our owner managers are getting back to growth. We're back on the consideration set with the brokers. We're well under our investor cap. We've built a mortgage centre of excellence to look after front, middle and back office. We've pretty much put nearly all of our mortgage processing into that, and we're getting much better outcomes in terms of turnaround times for our owner managers and our brokers.
Just to cover off on your margin element of the question, the guidance that we've provided is based upon the current settings, and I think what we would say is that we have not moved pricing that's seen this uplift. It has really been, our levels have been maintained. We would call out broader changes to the competitive environment that have shifted in our favour to make us more competitive in that regard. So that guidance is based upon the current position. We obviously can't make any assertions as to any future pricing decisions that we make from this point going forward. What I can say is that guidance does not include any pricing changes from this point.
And I do look at the front to back book margins on a weekly basis, and we have seen an improvement.
We'll take one more question in the room before we go to the phones.
Good morning, Andre Stadling from Morgan Stanley. Just a couple of quick questions. Firstly, just on the SVR repricing, so pretty much all the competitors have repriced in the last couple of weeks, very aggressively in some instances. Why isn't BAQ repricing? Is that signalling a little bit more appetite for volume over margin?
As you well expect, we don't signal anything about pricing because you're not allowed to. What I will say is that we constantly monitor where our pricing is, and we'll continue to do so, and we're acutely aware of what the industry has done over the last few weeks.
Just on credit quality, something hasn't received a lot of attention, but BAQ Finance in particular had a big fall in the loss rate from about low 70s to low 50s, and commercial was better as well. What's driving that, and how sustainable do you think these rates are?
The BAQ Finance credit portfolio, we've always said it would trade in a range because it is, it is asset financing. We did see a significant uptick when WA started to the economy started to soften considerably, and we did see an uptick in central Queensland around those mining-related areas. But again, BAQ Finance is one of those unsung heroes within the bank. We're spending about $10 million on upgrading our leasing systems, and we've already seen a significant uplift in novated leases. Under Hugh Lander's leadership, we've started to move away from some of the really cheaply priced broker-originated equipment financing into some other sectors. I'd expect that business would continue to trade in the range that we've indicated in the past. There's probably not much more in terms of improvement. On the commercial side of things, look, we've been judicious with our credit settings. What we have seen is, we've had a lot of development finance runoff at this point of the cycle, which we're happy about. We have a little bit of development finance left on the book. Loans over a certain size get pretty rigorous scrutiny at the Executive Risk Committee, but we are seeing we're seeing very good growth in Brendan's portfolio in those niche businesses. It is benign credit settings out there at the moment in the market. That's not to say that won't change. I think on the retail books, the one thing you've got to watch is underemployment. It doesn't get talked about a lot, and I think underemployment can drive stress in mortgage books. And where we do see stress, underemployment has been significant in those regional economies. Property seems to be holding up well. Commercial property seems to be holding up well. Development finance, it's tough out there at the moment. I think there's some tail risk in the market there at the moment. But we're happy with where we are at the moment. It's a good outcome for the cycle.
Specific to your question on the equipment, the BOQ Finance portfolio, that was a really good bad and doubtful debts expense result for the half. But a really powerful leading indicator for that performance is actually the arrears position, and the arrears position this time of year for that business now is very low. So we're reasonably confident that does point to a sustained level at where we are, at that level sustaining for at least the medium term.
Okay, we'll go to the phones now.
Your first question comes from Craig Williams from Citi. Please ask your question.
Yes, good morning. On slide 19, your non-interest income challenging headed slide. Trading income was $5 million this half and described as being at a more normal level. If you look at the previous 3 or 4 halves, I think 3 of the halves were sort of double that level, and the other was also comfortably above. So why can $5 million this half be considered normal, and what contributed to the fall witnessed this half?
Look, I think we've been saying for some time that the 8 to 10 range that we've been operating at was not consistently repeatable. And, there were things like contraction in semi-government credit spreads that had helped us through periods in the past that weren't evident this year. You've also got the instance that we actually have had a flat rate environment over this half. There hasn't been any movements in the RBA rate. And the RBA rate, and also the volatility in the curve has been less pronounced. Just, I think, simply lower opportunity. But again, it's probably at a level that we would say is more at the repeatable position. And sometimes we might do a bit better than that, and sometimes we could actually, this is trading income. You could always produce zero, right? So that's so in and around that area, if that helps.
Okay, thank you.
The next question comes from Richard Wiles from Morgan Stanley. Please ask your question.
Good morning, gentlemen. I've got a couple of questions. Firstly, on slide 31, as you pointed out, there was a big drop-off in settlements of investor loans in the half. Can you tell us if you actually had some growth in the owner-occupied book? And the 30% uptick in settlements that you referred to, John, is that being driven by investor property lending?
So the 30% uptick we've seen in the last 6 weeks is not driven by investor property lending. It's been a nice even spread amongst owner-occupiers and investor, and it's returning back to what we would see as the more normalised levels. Just in the last couple of days, we have seen a little bit of an uptick in investor. Who knows where the macro-prudential caps will go, and what will happen over the next few months. But we're well under the cap. We are very mindful of the right sort of lending at the right point of the cycle as well.
The areas where we did have growth being BOQ specialist mortgages and Virgin Money mortgages, both over-index in owner-occupier product over and above investor. And as John said, the 70-30 mix has returned more to, so whilst there has been a bit of a tick up in investor, it's been a tick up across the board with levels now more mix between investor and owner-occupier consistent with our portfolio mix.
So does that mean the owner-occupied book did grow in the first half? Yes.
Yep.
Okay. And then on credit quality, a couple of times you've mentioned some of the challenges in Queensland, outside of the southeast, sort of regional and northern Queensland. Is it too early to comment on whether Cyclone Debbie will have any impact on credit quality in Queensland? And can you tell us what happened to your credit quality after Cyclone Yasi?
I'll have to go back and have a look at going back to Yasi, we didn't see a significant change at all in arrears or write-offs. But my understanding from our people on the ground up there, this one has been just as bad, if not worse, than Yasi, and it'll have a significant impact, particularly on the agricultural sector in that region. I've spent quite a bit of time with the executive committee in the last 6 months where we actually go out to regional locations, and no doubt towns like Townsville, Rockhampton and Mackay have gone through a significant structural change as the investment in those mining-led regions has come back, has diminished significantly. Those big gas plants are now, fully operational and will be delivering national income to Australia. But again, you don't have the same sort of people that are there. I was in Cairns a few weeks ago with the executive committee, and Cairns is certainly doing really well through tourism, and the town has a real vibe about it. And it was really interesting to see big cruise ships pulling into Cairns. And I asked the local Chamber of Commerce, what does that do for the local economy? And they says every time one of those cruise ships pulls in, it fills up the place to the tune of $6 million. So we're actually starting to see tourism come back. I think the tourism industry will be sadly impacted, unfortunately, by this most recent cyclone. A lot of the islands have really, really been hit hard, but it is too early to say yet what those ramifications will be. But we've already put in place packages for our customers to ensure that they've looked after during what is a difficult time. I'll just say one thing too, a little bit more about mortgages, and we looked the other day at the number of mortgagee in possessions this bank has. It's 40 or 41. It's quite low. It's very, very, very small compared to the total number of mortgages we have.
I mean, traditionally, I think the sector across the whole hasn't seen credit losses as a result of natural disasters, other than really at the fringe, and no meaningful impact out of that. Perversely, maybe in some specialised agri sectors and things like that, if you've had exposure to that, there can be implications, and we don't have any concerns at this stage in the regard to our exposures in those locations. What can often happen, though, is the repair and maintenance activity that is required to correct everything does actually create a local economic boost to those regions, and we've seen that reasonably consistently time and time again when there have been these types of disasters, whether they be earthquakes or cyclones or floods, and it may well help in a medium-term horizon given that activity level.
Okay, I think we've got 3 more calls to take.
Your next question comes from Ashley Dalziel from Goldman Sachs. Please ask your question.
Hi, morning guys. Just a first one on capital and advanced accreditation. Could we just get a rough update on the time, I suppose, to application and maybe any quantum of investment if you were to still go down that path? And then just secondly, picking up the discussion around, I suppose, underwriting standards restricting your ability to compete in mortgages over the past couple of periods. And just noting that example you gave around the Sydney family, wherein you might have a max lend of 900k and peers were still at 1.2 mil. I mean, is that a pretty extreme example there, or is that pretty representative of, I suppose, the reduction in the system max lend that you think is going to come from these latest round of expense and income assessment?
So I won't make any comment about what other banks may or may not do under their underwriting standards, other than to say that we make sure that we're following what is prescribed by the regulator. And there have been times where, with our underwriting standards, we've either been in the market or out of the market. We're actually seeing the market come back to us. That's pleasing. And what I will say, and you've seen it in today's results, is that we need to make sure that we can get through the inevitable cycles that the Australian economy goes through, and everybody at the moment has seen rising housing prices for a considerable period of time. I remember when I bought my very first house in Sydney, the price didn't move for 10 years. So prices can go flat and prices can go down. So we're happy with the underwriting standards that we have, and we believe that the underwriting standards and what we've seen in the market over the last 4 to 6 weeks will allow us to get back to growth. Not in any way, shape or form going to actually drop our underwriting standards significantly to go and get growth. That'll only end in tears when someone else is sitting at this table in future years. And on the advanced accreditation piece, Anthony put up a really good slide that showed the work that we have actually done over the last few halves to get us to that journey. What is still incredibly unclear is around the regulatory environment, and there is, we're waiting to see what that regulatory environment will be. Hopefully, at the next half, we'll be in a much clearer position to say, yes, we're pressing the button to go to advanced accreditation. But everything we've been doing over the last halves has been making sure that we are in good shape to be able to do that if there is a significant incentive to move to advanced accreditation. That remains still pretty unclear at the moment with the impasse with the regulators.
Okay, I appreciate that, but given all the work that you have done, if you do decide to go down that path, how much time do you think you'll need to get that application in from the point of decision, I suppose?
I might just pass that to our Chief Risk Officer to make a comment on that. Peter? Sorry, the microphone's coming to him.
Yeah, thanks for that. Each of the parts on the right-hand part of the slide, there are some chunky elements to that, and I think it'd be fair to say that it's probably, if we were to start today the second parts and go quite hard, it's probably a 2-year plus time horizon to get us to the point where we'd consider putting an application in. And we do need to make some decisions on some of the aspects, how much you actually did want to do, because there are business benefits from a number of them, such as the data warehouse enhancements. I think the key thing, as John sort of touched a couple of times, is really the economics of, is there sufficient incentive for us to go? Because I think, as most people are aware, there's a fair bit of convergence between the requirements for a standardised bank and an advanced bank, and whilst I think the regulators are keen to make sure there is an incentive, I don't think the incentive is sufficient. It's certainly not what it was a number of years back. So that's a decision the bank will have to make, really, on the quantum of the investment.
And I think probably the only other element to that is that the staged process that's now potentially available through the regulator, as we understand it, requires that, to get your initial partial accreditation, you've got to have a defined and supportable plan to reach full accreditation within 2 years. I think given the work that we've done, if we were to go down this path, we'd like to think that we might be able to shorten that element and run some of that in a faster parallel process than maybe taking that next element of the remaining accreditation piece, given the progress we've made to this point.
Okay, thank you.
The next question comes from David Spotswood from Shaw and Partners. Please go ahead.
Thank you. Can you help us with the maths? 30% growth in settlements, what does that mean to the loans and advances? So if that's sustained for whatever, 6 months, 12 months, what will the loan growth be? That's the first question. Second question, you've got all different products out there. In the investor lending, where are you sitting in terms of your competitors? Is it a cheap product? Are you expensive? Are you middle of the pack? And the third question, the $80 million in other operating income, do you think that's a sustainable number going forward? Thank you.
Great. So the on the loan growth, the levels that we've got at the moment will see us achieve some growth momentum. Obviously, they take some time to come through into settlements. So, the growth that we're putting on today is the business that we wrote, 6 weeks to 2 months ago. So the second half actual growth, clearly we would expect would still be some gap behind system. But if we were to continue to deliver that, with a little bit of an increase on that momentum would see us at levels of growth at or just under system over time. On investor pricing, look, there's so many moving parts to that at the moment. There's interest only. There's a whole bunch of other elements. We are working on the interest only piece, and it's good. Probably I've got this question to keep John's blood pressure under control. It does demonstrate the spaghetti that we have across our organisation in making some of these changes, which we are actively making progress on removing. But this is something that for us will be a delivery in the middle of the year. But at the moment, our pricing level on investors certainly is not leading the market. But as I said, the market's moving rapidly, and we need to continue to monitor where we sit relative and make sure that the activity levels that we have give us sustained momentum. But we also need to make sure that we can't get them to a point that our fulfilment times aren't what they need to be to satisfy customer and broker and our owner manager expectations. So we will be refining and monitoring pricing levels on a very active and agile basis.
And the 80 million, the better base level you can sustain and grow from?
I'd probably go back to the comments I made when talking to the slide, which the speaker notes will be published after this session. It's an area that we continue to work hard on, just maintaining at flat, and we have work to do to get there. So I really can't add much more than that.
All right, thanks.
The last question comes from Scott Manning from JP Morgan. Please ask your question.
Afternoon, guys. Morning, guys. Just two things that I wanted to follow up on. Firstly, just on the non-interest income piece, the 80 million for this period included $7 million of equipment sales realisations from BOQ Finance. That number was $6 million in the second half of 2016, but was hardly noticeable in the first half. So I just wanted to get an understanding of what drives that and whether you think that particular number is actually sustainable.
Look, the nature of that line, you get either inertia income, which comes through the net interest income line, which is a customer gets to the end of their contract, might be 2 years or 18 months, and they just continue to pay on a monthly basis, and that just comes through the net interest income line. And sometimes or they hand the equipment back. And in relation to things like computer equipment, we've had actually some good uplift in our repurposing of that. So using some vendors that use global distribution networks to provide those assets to alternative uses around in different geographies to realise value. So there is a bit of a cyclical trend that will either come through the net interest income line or the non-interest income line, depending upon how that plays out. Some of those factors aren't just economic cyclicality. It could be there's a new change to computer technology, or new Apple iPads come out and people want to trade in to the new asset. But from a total revenue perspective, there might be an element of timing difference, but through the cycle they should relatively even out.
Okay.
And secondly, sorry, I just had a follow-up question. So on the owner-managed branch network and the reduction of branches there, on the other side of the balance sheet to what John was focused on, what are you seeing in terms of deposit runoff from those branch closures? If I go back to the branch opening story back in the 2000s, the idea was that you had this quote-unquote bow wave of growth from initial deposit growth followed by asset growth. So I'm just trying to understand any implications for deposit growth or any timing mismatch between asset runoff and liability runoff as you close these branches.
Yeah, so some of these branches are not actually closed. They're actually been taken back by net. The branches are down, but a lot of them have also been amalgamations. And when we've actually had successful amalgamations with owner managers, they actually continue with the footings that they actually have. So the two branches going into one, the footings pretty much stay the same. We're actually incentivising our owner managers around doing more around our current accounts and opening up those current accounts and activity. We're also doing a lot of work to help the owner-managers with the deposit pricing on our term deposits as well. You can't cut your way to greatness, to shrink your way to greatness as well, and we're very conscious that in Australian banking, and it goes for everyone, that branches play a predominant role in deposit gathering, and you need to have a healthy branch network to continue that. And we are very focused on that side of the balance sheet in terms of building up our deposit base. If you go back to the 2000s, and I wasn't around then, but a lot of the deposits that we built up have been in the TD market, and we need to do more work around building sustainable current account transaction deposit accounts. And that's what we've been directing our owner-managers to do. Okay. And Virgin will follow up with a deposit product as well. And, BOQ Specialists also has a deposit product as well.
We've got time for one more question, just here to my right. Thank you.
Thanks. Brett Lemaitre from Velocity Trade. John, it looks like in the accounts that Virgin doesn't make any money. Is that the correct interpretation of the disclosures?
No. There is a disclosure in relation to the other income line where there is contribution, and there is the expense piece related to that white labelled product distribution piece. So it is profitable in the period, and I can take you through the detail of that probably offline. There's obviously the expense base for the mortgage rollout, which we'd categorise separate to that, which you clearly only get a part portion of the revenue benefit on net interest income in this period relative to the expense base you've brought on to support that level of volume. So there will be a timing mismatch, but again, included within the totality of our mortgage offering, we don't see that as the case.
We see Virgin as providing us with significant growth. It is one of the few credit card books that actually has grown its receivables balance over a considerable period of time. The rate of uptake of the Virgin mortgage product is well ahead of what we thought it would be, and in the future, you could possibly see a lot more red across the organisation as Virgin grows. We look closely at what the experience of the Virgin Bank has been in the UK as a challenger brand, and it's been very, very, very successful. And this is early days yet in Virgin's journey, but we're very pleased with where we are at the moment.
Can you comment on what the profit was for the first half for Virgin?
Given the moving parts between the mortgage business and the other, I'll come back to you after.
Okay, that wraps it up for today. It brings the briefing to an end. So thank you, and we'll have some light refreshments on your way out. Thank you.
Thanks for everyone's time.